Hello, my name is Allison Archer. I'm a CPA in Henderson, Nevada. I have had my own practice since 2004, doing general accounting, tax, and bookkeeping. I received my undergraduate from the University of Arkansas and my MBA from UNLV. Today, I'm going to be talking about retirement plans. I will be giving a general overview. There are many rules regarding retirement plan contributions and distributions. If you are doing any type of retirement plan other than a 401k or a 403b, I would encourage you to seek the assistance of a tax professional to make sure you are under the threshold and your contributions are allowed. So first of all, we're going to talk about employer-sponsored retirement plans. These include 401ks and 401bs. A 401k is a tax advantage vehicle that allows employees to save for retirement. The tax advantage is that contributions are deferred on a pre-tax basis, which lowers your taxable income. And the funds, your contributions grow tax-free until you withdraw the money. Keep in mind, you need to be over age 59 and a half to withdraw the funds without a 10% penalty. Funds drawn before age 59 and a half will face that 10% penalty, plus you will pay income tax on them. The good thing about a 401k is employees can donate or can contribute up to $19,500 per year. And for employees over the age of 50, you can contribute an additional $6,500 for a total of $26,000 in 2021. There's another type of plan called a 403b, which is available to employees of certain nonprofits, 501c3 corps, colleges, universities, schools, and hospitals. There are two advantages also to a 403b, just like a 401k. First, all contributions and earnings to your 403b are tax deferred, similar to a 401k. You're only going to pay taxes on the contribution and earnings when you withdraw the money at retirement. The second advantage of 401ks and 403bs is that the employers match contributions most of the time. That is defined in the plan for your 401k or 403b. They will indicate how much they match. I encourage you to contribute to a 401k or 403b if you work for an employer who provides those benefits. And I strongly encourage you to at least contribute up to the matching percentage, because your employer is going to also put funds into your 401k that will grow tax deferred. That's additional money. There are other retirement plans available if you are not covered by an employer-sponsored plan. I want to talk about traditional and Roth IRAs. If you are covered by an employer plan, keep in mind IRAs may be available to you, but there are thresholds that you are subject to. So if you have the ability to contribute to a 401k and an IRA, I would definitely seek the guidance of a tax professional so that you do not over contribute to an IRA if you make over the threshold. We're not going to get into those details too, because that is a very technical conversation. So the first type of IRA I want to talk about is a traditional IRA. And you're able to contribute to a traditional IRA if you have earned income. So one of the benefits of a traditional IRA is that the money grows tax deferred and you're not taxed on that money until you take the contribution. Again, you need to be over the age of 59 and a half to avoid a 10% penalty. There is a maximum contribution. So in 2021, the maximum contribution is $6,000. If you're over the age of 50, you can contribute up to $7,000. Also, once you hit a certain age, there are required minimum distributions that you must take, or you face heavy penalties. Those start when you're over the age of 70. The rules have changed slightly, so I'm not going to give the exact age. It used to be 70 and a half, and now it has increased. The other type of IRA is a Roth IRA. These earnings are contributed with after-tax dollars, meaning you do not get a deduction on your taxes for contributing to a Roth IRA. But the benefit is when you take a distribution from a Roth IRA, you are not taxed on that withdrawal. So there are benefits depending on what you're looking for and what your plan is and what tax bracket you anticipate being in retirement. Now, like I said, you can be covered by an employer plan at work and also give to an IRA, but there are limitations that you definitely need to look into before you do those contributions. There are also many retirement plans available if you are self-employed. So a self-employed person, it just indicates that you do not have an employer, but you earn income, whether it's a 1099, just a side job, or maybe that is your main job and you get paid as a contractor and you receive a 1099. The benefits of self-employed retirement plans is usually the contribution limits are higher than IRAs or some 401ks. The first one we'll talk about is just a SEP. It's a self-employed pension IRA, and it's for those who are self-employed, you own a business, or you have freelancing or side jobs. Basically, it has the same investment distribution and rollover rules as a traditional IRA. However, the limits for contributions are much higher. You can contribute up to $58,000 or 25% of eligible compensation, whichever is less, for the year 2021. So that is a huge benefit. Another retirement plan for self-employed is a solo 401k. This is similar to a 401k, but it's only eligible to people who have no employees other than a spouse working in your business. You're allowed to contribute as much as $58,000 in 2021, but part of that is as an employee contribution and part of that as an employer contribution. But as a self-employed person, you are both of those, the employer and the employee. So it's definitely a benefit. There's also simple retirement plans and other types of retirement plans that we won't get into today. But that is just a general overview of different types of retirement plans that are available to individuals. If you have additional questions, I definitely encourage you to go to www.irs.gov or seek the assistance of a tax professional, because the rules for retirement plans are very complex. And the penalties for not following the rules can sometimes be significant. Thank you for your time.